part of our job at AIMA as a global trade association is to ensure that those headlines are managed and that people are educated around private credit and things are understood. This actually very much reminds me of hedge funds 20 years ago. As this asset class is growing, it's becoming under more scrutiny. As with most things, success can breed some negativity. So today we're really going to dig into what private credit is, the difference between the public markets, and what you should and probably shouldn't be worried about. So I'm going to ask my panelists to introduce themselves briefly, and then we'll get into the weeds of this. So starting with Sven, please.
Thank you. I'm Sven Janssen. I'm one of the co-founders and CEO of a company called Tradition Meets Future. We are an investment platform specialized on structuring and arranging growth debt facilities for European scale-ups, and we have offices in Germany and in France. Thank you.
Hi, thanks for having me. I'm a partner of SC Lowy. We're an asset manager headquartered out of Hong Kong, running about $3 billion of capital, specializing in private credit in Asia and the Middle East.
My name is Jamil Hallak. I'm a CIO of a Saudi family office based between Dubai and Saudi Arabia. We follow very much of an endowment style strategic asset allocation. We invest globally throughout the public and private markets. So we do everything from private equity, private credit, real assets, hedge fund, and all liquid strategies. I've been in the investment universe for over the last 25 years. I'm very happy to be in this panel. Thank you, Fiona.
Hello, everyone. I'm Tom Murray. I'm the managing partner of Power Sustainable Infrastructure Credit. I'm part of the Power Sustainable companies investing in sustainable private equity and credit. Our parent company is Power Corporation of Canada out of Montreal, a $1 trillion plus asset manager, and one of the largest in Canada. And our focus on the infra credit side is on high yield infra credit, double-digit returns across telco, energy, sustainable energy, transportation, social infrastructure, you name it. A lot of different areas of focus for us.
Thank you, everyone. So I'm going to start off with asking Jamil a question as our allocator on the panel. So what do you think's driving this convergence between private and public markets?
Thank you, Fiona. So looking back 25 years ago when I started on the trading desk, I think private markets used to be less than 5% of, let's say, the credit as an asset class. Today, that percentage has evolved. And I want to make one small observation. It doesn't matter whether it's public or private. It's one asset class. So, the underlying risk is the same. So the methods have changed, and those methods have changed due to various factors from the demand side and from also the borrower side. Which makes private credit evolving as a bigger method of financing within the credit universe. So one of the things is obviously regulation have put a lot of strains on the banks. So private credit is actually a very old job. It's the same people at the banks doing the same job in a fund format. So Vodafone, if they want to borrow, they have several methods. So either they can borrow against the receivables down to a PIK or a private credit because they want a much faster borrowing, not rated, and a bigger large format. So the lines between private and credit are basically getting thinner, and today I think private credit is around 3 trillion. We expect that size to double over the next 5 years. So it's inevitable that private credit will be a much bigger percentage of the credit as an asset class.
And have any of our other panelists got any views on that and what they're
Well,
seeing? As
just one consideration, which is, I think, worth keeping in mind. Private credit has an illiquidity premium with all the pros and cons that comes with it. And that is something that obviously, especially when it comes to the transaction and the transaction costs, have to be borne in mind.
And I think it also needs to be said that private credit is a very broad church. Earlier today in the first panel, they talked very much about US credit, private credit, and the challenges that everyone's talking about. But it's a hugely broad church. You've got the range from venture debt, asset light, through to senior secured, asset heavy, downside protection. So I think it's important as well that people understand the difference in risk profiles. And in the US, one of the biggest challenges is these large managers are now running huge amount of money and they're competing against the banks. And they're using leverage behind themselves in order to bump their returns for their LPs. That's a very different risk profile than an unlevered, hard asset backed type private credit.
Yeah, the only thing I would add is I do agree it's all credit. I think the markets are bifurcated really because of regulations on the banks around more high-grade issuers tapping the public markets and more high-yield issuers targeting private credit. So there's inherently more risk in private credit, not because of the structural features of private versus public, although there's some areas there to be discussed. But in general, you're just looking at weaker credits, generally smaller middle market companies that need to borrow. Private credit's going to get a bad rap relative to public credit because of that. But if you realize that it's really just a different part of the market, it shouldn't be considered private versus public. It should be high grade versus high yield, in my view.
Thank you, Tom. David, as a manager, how are you sort of managing these changes? How's that being reflected in your portfolio?
Yeah, so we were founded in 2009 in Hong Kong. Our core market is Asia. We grew into the Middle East actually very quickly. We started investing in the region in 2011, but focused very much on secondary credit where we're buying existing bank loan positions and claims. We also grew into Europe. Post-COVID, we found that the huge amount of liquidity that swamped the market in those developed markets and the amount of lack of opportunity because of the post-COVID world with the higher regulations and so on meant that from a risk-adjusted basis, we found much more interesting opportunities back in Asia in our core markets and here in the Middle East. At the same time, the private credit space has grown dramatically, particularly in Asia. And as a result, we retrench back to our core markets, and we believe we return very strong risk-adjusted returns for our LPs. We tend to focus on the mid-teen net unlevered returns with hard asset collateral and senior secured risk. What we're seeing from allocators, and Jamil can certainly talk to this, and I speak to allocators here in the region. Previously, there was a big focus, quite rightly, given the bull market, on private equity in US and Europe in particular. We've seen quite a big shift the last couple of years towards a more balanced portfolio, both towards credit and towards Asia, and also a lot of investment within region here in the Middle East. So that growth in private credit it's much more nascent than the liquid markets and very efficient markets in the US and to a lesser extent Europe. But there's a very big opportunity and a real big growth opportunity in Asia and the Middle East now.
Jamil.
I can add a few words. So I think we look at the investment in credit in general in two ways. The first one, we want to use, let's say, public market as a tactical allocation. and private credit as a strategic allocation, which is a bit more long-term, has more drivers behind it. Bear in mind that not long ago, like 5 years ago, private credit was not part of an asset allocation. And now more and more, you will see it part of the asset allocation. And that integration goes, as David said, there's a learning curve, there's an education behind it, there is an experience, there are tests of cycles and markets that goes behind. So this region is integrating private credit into the asset allocation. And a lot of people, and I talk to it with my own IC, is there is a lot of experience on the private equity side. But funny enough, the majority of them don't know that the private equity side is supported by that private credit. So there's no private equity without private credit. So that's the angle. From a risk map point of view, we try to look at no intersection of risk, and we try to look at also different style of risk, but the same underwriting discipline and no drift in terms of strategy. I mean, we look at, and I say that to my teams, is, you know, you can have 5 strategies that gives you 10%, but how do you differentiate these strategies? You differentiate it by looking at your downside protection, the quality of your risk, and how sustainable, I mean, if you have to simulate that portfolio, how resilient it's going to be. I mean, that's how we look at it.
Thank you, Jamil. Sven.
Well, further to David's comment about the broad categories that exist within private credit, I mean, stating the obvious here, but one consideration is ultimately it's an instrument, it's a financing instrument, and the real risks lie in the underlying assets. So are we talking about a corporate credit risk? What kind of corporate? Is it infrastructure? Is it real estate? So it's very, very broad. That's one consideration where it just needs much further differentiation to gauge and to understand the underlying risks. And then secondly, and that refers to the actual instrument, is the complexity of the structuring. I mean, I'm a fairly simple-minded person, so if I look at credit structures and if I don't get it within 5 to 10 minutes, I wouldn't touch it. And because on the one hand, it allows for a lot of structuring, which is great, and you can effectively structure that instrument, which then becomes close to being an equity investment to some extent, economically, not legally, or a pretty conservative plain vanilla debt instrument, just purely interest-bearing and fairly predictive, cash flow stable. So, and that complexity requires a lot of education, and investors are, I would say, at least in Europe, for which I can speak, are still in a kind of trial and error phase where they get to learn and understand when and where can I reasonably apply private credit, to which sectors, to which asset class, and what kind of structuring would I use, and where do I feel comfortable with the complexity of the structuring. So.
Yeah, the only thing I would add is, you know, the reason why private credit exists from an LP perspective is it generates alpha. If you're in public credit, you know, with a lot of secondary trading in those assets, or even in bank loans, there's so much competition that there's no alpha. So private credit is a place for all LPs to potentially generate alpha, but that's going to be driven in large part by the manager that you select. And, you know, what I would say is alignment of interest with that manager is going to be really important, that they also have skin in the game alongside of you, as opposed to, you know, a lot of the larger managers that put in 1 or 2% GP commit, and then they're really playing with your money, and they're really driven off of fees versus, you know, performance. So I think it's a great place to invest. There are downsides, which we can talk about, but it really is about, you know, asset manager selection versus, you know, doing your own due diligence if you're a, you know, regular way direct investor in the public markets.
Thank you, and I want to stay with you, Tom. As it's been mentioned today and in the press, A private credit bust is looming, allegedly. So how resilient is private credit to a downturn? And what is it that will test today's private credit structures, Tom?
Yeah, good question. So first of all, again, back to the point that credit is credit. There's a private component to it and a public component to it, but it really is all just credit. And so any downturn is going to have an adverse impact on corporate credit generally, reducing cash flows available for debt service, increasing interest burden on the borrowers, and reducing credit availability for those seeking refinancings and business expansion. I think I'm going to take a bit of a negative view here to start with, because then my colleagues are going to fight me on the positive, so somebody has to be the bad guy. But private credit really does have more risk, and that's really driven by lower credit quality issuers, companies that are generally in the double B to single B range, so much higher risk of default and lower recoveries. There's also an oversupply of capital right now, in my opinion, that is funneling into private credit. That's causing weaker structures, covenant packages, things like that. It's causing increased, or actually weaker alpha, notwithstanding the fact that there's still alpha in the space. You'll hear that there's less government oversight, less rating agency involvement in private credit, so it's really up to the manager to decide whatever they want to invest in. More opaque to the ultimate LPs. And then, I think there's, as I mentioned earlier, a prevalence toward, more money coming, LP money coming into funds, which is then getting invested in private credit. So you really have to look at the alignment of interest with your manager, because if they're not aligned and they're really fee-oriented investors, they're actually not going to try to maximize IRRs on your behalf. So those are some of the resilience, down in a downturn. I would say, if you look at private credit today, it's about $2 trillion. There's different estimates, 1.5 to 3 trillion of capital. So it's now a very big part of credit. Still only about 10% of all of credit, but a very large part of credit. And there's indications that lenders are becoming more aggressive and maybe overly aggressive in this space. Very high leverage levels, as an example, 6 to 7 times EBITDA. When I was doing this way back when, 3-4 times was kind of the norm. That's partially driven by unitranche structures, so lenders that are not only coming in as senior secured, but they're lending the whole component of the cap stack, including the junior side. Things like covenant light structures are becoming more prevalent. PIK and PIK toggle, that's payment in kind for those who don't know what that is. That's as opposed to paying cash interest, you're just accreting the balance of the loan over time. And then uses of proceeds is also important. Dividend recaps are not necessarily ideal if you're in a scenario where there's a potential downturn. What you're really doing there is you're replacing debt, or you're replacing equity with debt, reducing private equity's exposure to the business and increasing your own exposure. We generally like to see a fair amount of equity cushion in our deals, so seeing dividend recaps is not necessarily, in general, a great thing. I'd say also that fund level leverage is a component which was mentioned earlier. Not only are we buying loans in some cases, but we're also back levering these loans. BDC structures back lever themselves, up to 50%, and that exacerbates the credit risk of the underlying portfolios, which are already sub-investment grade. So, all this is leading to what? It's leading to Jamie Dimon saying there are cockroaches that are coming out of the woodwork, and there's probably more of them to be had. You're seeing public CLOs that are trading well below NAV. Not that that's, but a little bit below NAV is kind of normal, but well below NAV, and some of them at 70, 80% below NAV is an indication that those underlying portfolios are not strong. And I think the trigger for all this could be an increase in interest rates by as little as 100 to 150 basis points that could actually result in some pretty ugly downside scenarios.
Can I just point out that all of that I agree with, but it's very US focused. The US is 72% of all the global private credit market, right? So the US dominates the private credit space. Europe is the next biggest with about 24%. And we see a lot of those structures in Europe as well, which in our view is leading to the higher risk of the private credit market. Whereas where we operate in our markets, the private credit space is much more nascent. And therefore, the way we manage our risk, so our existing investments, we always have very heavy downside protection. So we're always unlevered and secured against hard asset collateral so that we know worst case scenario, if the company has difficulties, we can enforce and get our money back. Worst case, don't want to do it, but worst case scenario. On the other point is actually a downturn actually leads to opportunity, because what we see in downturns is that banks retrench away from the mid-market and away from certain sectors. So for example, we're very active in South Korea at the moment because of the regulator putting pressure on traditional lenders in the real estate space, and we're finding great risk-adjusted returns with very strong asset collateral in Central Seoul. So as an example, we actually see opportunity in some of these downturn scenarios.
Yeah, very, very quickly, you know, I'm in between, you know, the panelists, so we are ready for any downturn by having optionality on some distress, opportunistic managers in the liquid market and private market. But one thing I want to say, at the end of the day, your risk is a legal documentation. So whether it's public or it's private, you know, you have to look at the legal documentation that is attached to it. And that is your resilience. So we talk a lot about resilience, but the reality, what is it? And how this, you know, and how do you quantify that? We expect a lot of divergence from managers. So, you know, your usual first quartile managers probably won't be the first quartile anymore. So there is an extra diligence. And we look at, you know, the growth of the private credit market as an opportunity in both cycles. You know, when things go wrong, we step in and we try to be well positioned. And, you know, there is a very good, healthy part of the private credit market. You talked about the US. If you look at the middle market in the US, is above $10 trillion. That's larger than any combined GDP in the world. And I agree as well that you have to look at other geographic areas like Europe, like Asia, and obviously being careful on how the underwriting it is. So I think that there are a lot of strategies that you know, will make sense. We don't have to look at it in a negative way, but you have to be positioned if these scenarios happened to benefit from it.
And that neatly leads me on to the final question. You mentioned firm documentation. I'm sure the lawyers in the room will be happy to hear that. But where does regulation and transparency fit into this, Sven?
Well, I mean, I'd like to say, strictly speaking, there shouldn't be any private credit. Slightly provocative. If the banks would have been able to keep being entrepreneurial financing partners, then there wouldn't have been the emergence of private credit. So what I'm saying is, to some extent, the gradual disappearance of entrepreneurial lending from the banks, if you look at it in a more historical perspective, has led to the emergence of private credit. And so it's to some extent a substitute and now emerging as a complementary instrument. But effectively, one aspect why the banks have withdrawn is due to regulation. Clearly, there are other reasons as well, but regulation has played an important role, while demand for non-dilutive capital has remained in place, and the flexibility of structuring certain instruments. I call it entrepreneurial debt, and then it takes all shades of gray to structure it according to the client's needs. And the banks are no longer in a position to provide that flexibility, whereas certain niche players, if you may still call private credit in a way, niche players offering tailored solutions are able to do that. So I can see the desire of regulators saying, oh, there's a shadow banking market emerging, what are we going to do with it? And of course, you know, the leverage that we see in the United States itself poses some kind of potential structural risk. I mean, I'm not denying that, but I can also see that if you step in and over-regulate the private credit market, while there is still demand for these kind of instruments, you know, I don't know where that would lead to. So I think the smartest way is to obviously liaise with the LPs, with the investors, and clearly define and have a common understanding of the underlying risks, which goes back to Jamil's point of, you know, documentation must be understandable, must be comprehensible for a start, and that the risks are clearly accountable, and that you need to understand the collaterals. So being transparent as a GP, as an asset manager, and having an open discussion about the underlying risk is quintessential. And it's what you really need to do with your fiduciary duties towards your LPs as well. I mean, and that will, to some extent, keep regulators, hopefully, at bay as well.
Tom, you wanted to add something?
Yeah, I was just going to say I agree with everything you said. I think the way to think about private versus public credit is the manufacturing of credit products in mass for companies that are relatively simple to understand, or at least have a risk profile that is relatively high. The purpose of private credit is to dig in deep, and if your manager is doing their job, they're digging in deep into the details. They're understanding the underlying businesses as well as private equity investors are. They're structuring the deals with tight covenants, with security, and a lot of other protective features. And you know, through that, they're generating a lot of alpha for you. But again, it comes down to the manager and their capabilities to execute on good investments, to source and execute on good investments. So I just throw that out.
Thank you. We're fast running out of time, but I would like this panel to end on a positive note, please. So in your own words, one sentence each, please. What are you looking forward to with regards to private credit over the forthcoming years? What are you excited about, Sven?
Well, finding solutions for, in our case, in particular, finding solutions for entrepreneurs who are struggling enough with their operational challenges and want to find non-dilutive growth capital, and being able to recognize their specific needs.
David?
Yeah, we continue to be very excited about our markets in Asia, but our next real push is the nascent market, which is super nascent in private credit in the Middle East. There are now very strong legal frameworks in place. There's a very sophisticated professional ecosystem. We've been involved in the region for the last 15 years, and it's ready for a real private credit push, which is almost non-existent at this point. So that's our next challenge.
Jamil?
Yep, we're very excited about the evolution of the asset class. You know, there is 3 trillion of refinancing wall coming up the next 2-3 years, so that will create a lot of interesting situations, mainly on the capital solution side. Yeah, we're positioned to look for that, how that refinancing of that wall will happen. We like the asset-backed financing as well, all the, you know, infrastructures, digitalization, all these, let's say, financing backed by proper asset. That's the non-corporate side of the, let's say, the credit, which is a huge addressable market, I think around 5 trillion. So We like that, and we're waiting for some volatility on the public market as well to take advantage of. So it's going to be a great opportunity for the asset class as it grows.
Yeah, I would say infrastructure private credit is probably the most interesting part, not because I invest in it, but there's a little bit of an element of that. But really, the size of that, the need for creative solutions and infrastructure globally is in the trillions of dollars. In general, infrastructure can't afford a lot of expensive equity, so having a bigger component of credit is going to be critical. And then if you look at infrastructure, there's a lot of downside protection built in, hard asset collateral, contractual cash flows, long-term predictable businesses, limited competition, I mean, you name it. So I'm very bullish on high yield infra credit.
Thank you. I'm going to have to close this panel now. I think our panelists have done an excellent job in hopefully smoothing some of your fears. Thank you.